This is Trading Lesson 56, delivered by Twigbe Eizogi for Forex, crypto, stocks, options, and all chart-related trading. You're advised to subscribe, share, like, and make comments. You can contact us for account management, training, consultation on +234 803 7597 085. Making money has to be a trader's primary objective, and the long, boring stretches, interrupted by brief moments of anxiety and uncertainty, are inescapable components of the job. If traders wait several hours and there is no setup, they will tend to become complacent. Once the trade begins to set up, they will sometimes not be mentally ready to take the trade. However, that is a challenge that they must learn to overcome. They are trading to make money, and they must learn to perform when the time is right. Firefighters wait for days, never knowing when the alarm will sound. But when it does, they have to act immediately and perfectly. They are professionals and get paid to do their job correctly. Traders also wait for events that come only occasionally, but they have to learn to be professionals and respond quickly and precisely when the time comes. If they can learn to be comfortable in this environment, they are in a good position to make a living as a trader. A friend once told me that he lost money for many years and never made money until he stopped taking counter-trend scalps. He now makes over $1 million a year. He discovered the importance of taking the best trades, and that made all the difference. Most traders should keep things simple and try to do the same thing on every trade until they are consistently profitable. Stop entries are better than limit entries for a trader starting out. If he finds himself changing his plan after he enters, he should just place his bracket orders, walk away, and come back in an hour. If he's worried about money, as soon as he places his trade, he needs to trade a much smaller position size. If he has been trading 500 SPI shares, he should trade only 100 so that he is in I don't care mood. It is better for a trader to win on 60% of his trades using 100 shares than losing on 80% using 500 shares because of anxiety that prevents him from following his plan. If he is always eager to place trades but constantly wants confirmation, resulting in him only buying at the top of a strong bull spike or selling at the bottom of a strong bear spike just before a reversal, then he needs to work on patience. He should avoid entering on breakouts and only enter on pullbacks. To improve his patience, he could try limiting himself to 3 trades a day. Once he has taken them, he would have to wait until the next before placing another trade. It takes a long time to become patient and able to not take trades while watching a lot of great ones go without you. When he has any doubt about a setup, he should assume that the confusion is his radar telling him that the market is in or about to enter a trading range, at which point you should only buy low and sell high. For a major trend reversal, there has to be a strong break of a major trend line, with the first reversal leg showing a lot of momentum and having a strong reversal bar. Smart traders will then wait for a test of the trend history and enter on a successful test, a lower high, double top, or higher high in a market top, or a higher low, double bottom, or lower low in a market bottom. They want the signal bar to be a strong reversal bar. If the setup does not have every one of these components, they should not take the trade. A trader will often have to take several signals before one finally evolves into a trend. But the trades that do not are usually small profits and losses that offsets each other. If traders are comfortable trading in a fast market and increasing their risk, they can enter with the trend during strong spike. For example, they could sell the close of the second, third, or fourth bar of a strong bear spike and use a wide stop to possibly even above the top of the spike. Great baseball hitter fails 70% of the time, but still makes millions of dollars from that other 30%. An experienced trader can win 60% or more of the time and have an average win that is larger than the risk, and sometimes 2 or more times bigger. Be patient, but when the setup that you have waited for finally arrives, learn to take the trade and trust the mass. The easiest setup to recognize is a two-legged pullback to the moving average. The pullback to the moving average usually looks like it could never lead to much of a trend move, but invariably the move will take out the old trend extreme and run much further than you would ever imagine. It is important to swing part of every trend entry on a strong trend day, even though that means that sometimes your break-even stop will be hit on the strong portion of your trade. However, the big runs will more than make up for this. At every new setup, you can either simply add back your scalp portion or instead place a full position on top of your current open swing position. Once you scalp out of part, your swing portion is then twice the size of your normal swing, or thrice or 4 times. If you keep adding on at every new signal, most traders will find it easier just to add their scalp, contrast back, or to simply stick with their original position and scale out at different profit levels. Otherwise, we end up with too many contrasts to be comfortable, and discomfort makes it hard to follow your rules. Market has inertia, and as such, when it is trending, about 80% of attempted trend reversal fail to reverse the trend and become flag continuation patterns. Remember, a pullback in a trend is a failed attempt at trend reversal. Therefore, trading pullback is a reliable approach to trading, and it is the approach used most by the majority of successful traders. So pullbacks are large and extend for a couple of days, and the entry can appear to be a reversal entry. But if you look at a higher time frame chart, or if you compress the bars on your current chart to see more days, you will see that it is just a pullback.